welcome back. For those of you who come fairly often, this would be the third edition of our emerging tech session. So 3 years ago, we started with NFTs, and then last year we did decentralized infrastructure, and then this year we decided to go with finance, and more specifically, digital assets and stablecoins. So I thought, what's more dramatic than the crossroads, the Model T? We're at an inflection point in how money moves from cash to cards, digital banking, and now programmable finance. It's a digital transformation of capital. It's about the rails of business we use to transact globally. 2025, in my opinion, is the official year of it beginning its mainstreaming. This should matter to any Canadian business doing any kind of global business. But first, let's level set with some terms, market stats, and some opportunities before we jump into that. So before we get into the digital assets and stablecoins, it's worthy to mention briefly about open banking and open finance, as it's often mentioned as sort of the counter to anything that's blockchain related. The open finance and open banking represents digital transformation paths for traditional banking, TradFi. And it's been positioned as the bank's system's answer to modern finance for the digital economy. So when you're thinking of open banking, think about financial apps as a USB port. Instead of your data being locked in the bank, it's APIs that let you securely plug into other services, like budgeting, apps. You might have remembered a company called Mint, which was popular for a brief moment. That would be an example of it. Open finance takes it a step further. It adds more ports, connecting you with insurance, investments, even utilities. And it's about your data working for you across the entire financial ecosystem. If you look at how finance has evolved and more complicated than I can cover in one slide, but it's essentially from banking ledgers, digital money, your online banking that you're using, and then open banking and open finance, which uses open data and APIs. And then from there, some countries are pushing towards a central bank digital currency with open data systems. While blockchain finance I view as an emerging independent global alternative to capital flows. It can work with TradFi, but it doesn't have to. Which leads us to stablecoins, a product that connects these two paths. Now, bringing it back to Canada, you might be surprised, but we're lagging in this area. Our open banking framework implementation isn't expected until 2026, which would make us last in G7 to roll it out. Legislative amendments to the Canadian Payments Act was announced last week, opening Payments Canada membership to new players. This is a positive step, but it's still incremental and it's not 2020 anymore. There's countries like Brazil and Singapore which are already moved to full open finance, and they're experimenting with blockchain-based settlements. The takeaway is simple. Canada's innovation in this area is policy-led, while other markets it's market-led. This is creating a real competitive disadvantage for Canadian businesses. And that brings us to the bridge. Payments are effectively becoming the transition layer between TradFi and DeFi, and stablecoins are the real-world use case that connects the two worlds. So, now we can move into digital assets. And really how I would look at it is a digital asset is any form of value, rights, or ownership that exists in digital form, can be transferred, stored, or traded using digital networks. You can think of it like email digitized letters, blockchain digitizes assets, money, investments, contracts, and participation rights. And there are four main categories here to look at a high level, which is money, which would be any type of cryptocurrency, stability, which would be stable coins that are pegged to a real currency. And then you have the asset category, where it can be tied to like real estate or bonds and represented on a blockchain network. And then there's participation, which gives you a right for access or voting or membership. And together, these represent a spectrum of ownership on how to pay, how we invest, how we participate. And then for those who are in the industry, I kind of broke it down how a lot of different people are looking at it. And mainly, I put that on the slide, not to confuse everybody here, but I thought there might be at least one Bitcoiner in here. And they would be, there we go. And you would be very upset if I did give you your own category, which is digital commodities. So it's for the one guy over there. So we can talk about stablecoins in a moment, but just remember this broadly. This is the digital asset landscape, and these are the bridge products actually connecting traditional finance with decentralized finance. So if you think about stablecoins, it's really just digital dollars. There's 4 different kinds there can be, but essentially it's currency built on a blockchain, and it's pegged to something like a US dollar. So it could be, the ones that are being talked about the most right now is USDC and USDT, and they are required to do a 1-to-1 ratio peg, at least in operating in the US. And then you have ones that could be backed to a cryptocurrency like Ethereum, Solana, or something like that. There's gold, and then the last one, as far as I know, it doesn't work anymore, and there's no examples of it working that I have found, but I put it on there just in case it comes up and you want to know what it is. So the goal is simple, to bring the speed and programming of crypto without the volatility of crypto. Stablecoins are no longer a concept. They're fast becoming a key part of the global financial infrastructure. As I mentioned previously, they're playing a bridging function with fintech payments between traditional finance and blockchain, the foundation for programmable borderless payments. So I'm an analyst, in case you didn't know. So I like to have numbers, I like to have stats, and they need to be as big as possible. Sorry, the font, I couldn't get it big enough on there, but stablecoins are creating real business value today across payments, payroll, commerce, and treasury management. And we've seen over $7 trillion settled on chain this year. That's more than Visa's annual volume. Cross-border remittance alone are heading towards 60 trillion by the end of this decade. And stablecoins are already cutting costs and settlement times from days to seconds. The blockchain infrastructure is finally robust enough to displace some of the TradFi options out there. Banks, fintechs, and even corporates are now using stablecoins for instant liquidity, global payroll, and on-chain finance. More than 30% of stablecoin supply is already held by institutions and no longer represents crypto-native retail activity only. So when we talk about Canada's position, keep in mind, while the rest of the world is deploying this technology, we are still lagging, and the gap represents both a competitive risk and a policy opportunity. Stablecoins are no longer about crypto, they're about how money actually moves in a digital economy. The business case for stablecoins is simple. It's faster, it's cheaper, and it's programmable. Traditional finance still moves like it's 1995, taking days to settle and wasting over 120 billion in fees every year. Stablecoin settlement is instantly run 24/7 and frees up liquidity. No intermediaries, no banking hours, no multi-day waits, cross-border payments. That's why Fortune 500 adoption is up nearly 50% this year. These are financial rails now being built by the world's largest banks, payment processors, and tech companies. The question is not if the technology works. It's already been decided. It's who is leveraging it the fastest right now. And across the US, Europe, and Latin America, adoption is accelerating. Canada, meanwhile, I'll leave it with this. I think we are at a competitive disadvantage for business that operates globally. I've already come across several businesses this year that do not accept fiat or SWIFT in payments. These are not small companies. These are investment firms. These are outsourced labor organizations. They're not willing, they don't have to take fiat, so they don't. And if your international partner moves on chain and you're not, your form of payment may not be accepted. It's something to consider. Think about how technology has flattened the world over the past few decades. You know, we have the internet made it possible to communicate with anyone. It connected your ideas and business value proposition. You have e-commerce and the Shopifys that made it possible to sell to anyone. It connected our markets. And now stablecoins makes it possible to transact with anyone instantly, securely, and globally. It connects our money. Together, these three waves, communication, commerce, and now capital, represent further flattening of global business. And this time, the advantage doesn't go to just large resourced organizations. It goes to whoever wants to adopt it the fastest. And essentially, if you're a small business, you can bypass having to scale domestically to go globally faster. It's one of the pathways or one of the levers that you can work on, because international banking is a barrier to global business, especially if you're a small business. And I can say I know from personal experience on that end. So as the world builds these rails, the question for Canadian business isn't whether it's a thing, it's what we're going to do about this shift. I mean, you don't have to do anything. We'll be pulled along anyways. The race for global settlement rails is underway. These are all the players here. You can see that it's not just crypto companies anymore. Big tech has jumped into it. Stripe has, I think, onboarded or is in the process of onboarding 30 countries right now. Whereas you're not going to really have to do much. It's just going to be in their dashboard to accept as payments. And they've made two significant acquisitions this year to basically say, like, we want to be the payment rail for business globally. And then you have, of course, more than just BlackRock and JP Morgan, but I can't fit them all on there. But you got all the major banks doing some sort of investment or play or support. You have the Visa and MasterCard doing it. You have SWIFT that just announced that they're going to build a blockchain, but 2 years too late, probably. Nobody cares about that brand if you already have a blockchain network that works. There's been over $7 trillion that's been settled on stablecoin rails in 2024. And, just for perspective, Tether, which is the market dominant for stablecoins, has roughly 60% of the market. And they're the 18th largest holder of US treasuries, ahead of countries like South Korea, UAE, and Germany. So this is not a small thing. And the takeaway here is simple. This is a global race for financial rails. It's already being run and adopted by the world's largest companies, not just startups or fringe crypto degens anymore. So regulation is now shaping the playing field for stablecoins. We're watching two different strategies emerge. This is what changed this year. It's really the Genius Act of the US. That is really what has pushed all this forward. So that's what you have with the US. The EU is taking a different approach, more of a control, gatekeeping I'd say, narrow type of process, whereas the US is more of open up the floodgates. I mean, you got Walmart and Amazon that also want to do stablecoins now. And so in the US, it requires a one-to-one reserve and licensing, but leaving room for market-led growth. In the EU, it focuses on control and harmonization with caps and non-euro tokens and heavy compliance requirements. I mean, the UK right now is essentially trying to block any stablecoin that's not UK-based right now. And then there's Canada. Well, what can I say about Canada? Effectively classifying stablecoins as a security. So basically tax fundraising, I suppose. For now, the US and the EU are actively shaping global digital asset rails. Canada risks transactional disadvantage. Canadian firms will settle on foreign rails eventually, or they'll do what most Canadian businesses do when regulation doesn't work. They offshore to participate, to decrease market technical costs. The question is no longer about technology, it's about policy alignment and competitive readiness. And worst case scenario, if Canada doesn't move, we'll be using other nations' infrastructure to run our own digital economy just to participate. So with this, we are standing at the crossroads, as I mentioned, and we can either go with the black Model T or the future. One leads to status quo and the other opens up global opportunities. Capital will always flow where the rails are fastest. Innovation will always scale where regulation enables it. And right now, those rails are being built, whether we participate or not. Canada risks being left behind, not because we lack talent or ideas, but because our rules haven't kept pace with global infrastructure. If we want to capture our share of this 60 trillion digital asset opportunity, we need to unlock innovation, enable capital to flow into Canada's ecosystem. Our choice is simple: participate or spectate. At the end of the day, policymakers set the rules, but it's up to business communities to show what's possible. So I'll leave you with this. Canada has the talent, the capital, and the opportunity, but we need to move faster. And if you want to hear more stuff about anything that I'm following, you can find it on my LinkedIn with the newsletter. I post all these stats that you saw periodically of whatever it is I'm following. As well, I often do podcasts with anybody who's building something interesting.